small businesses which have accounts with banks, so we're talking about banked clients, who are not able to avail of existing loan products and therefore have to seek financing for their businesses through the informal financial sector or alternative lending. The area that we focus upon is the constituency of small businesses which have a bank account, have a relationship with the bank, but the existing loan products offered by that bank do not suit the requirements or characteristics of that small business. So on the one hand, you might have a sole proprietor type of loan, suitable and driven by the bank's decision on the personal credit score of the sole proprietor. On the other end, you have bank products driven by the SME division, which are larger loans where the bank looks at the collateral of the business to secure the loan. And you're looking at a very methodical approach to underwriting, an expensive, laborious process, which would only be economical for a bank of loans of a larger amount. Small business account holders who may not have collateral. They may just be in a business that would never have collateral. Retail sector, doctors, dentists, optometrists, any kind of service sector. These businesses could be around for a very long period of time, but they will never have collateral. The typical borrower through AMP's technology has been around as a business for 7 years. 7 years. So it really gives an indication that these are businesses that are able to thrive in all environments, or certainly survive in all environments. And yet, although they've been on the banking grid and had a banking relationship for that period of time, the bank has not been able to satisfy their credit needs with a product that suited the purpose for which they could qualify. From the beginning, our idea was to enable banks to utilize information in their databases, albeit on different parts of the bank, and more efficiently bring that together so that they could perform character capacity analysis on small business account holders, supplemented with external information, dramatically making more efficient the cost effectiveness of underwriting a small business loan of a relatively small amount over a short period of time. So say less than $100,000 US with a 1-year tenor. There's only so much money a bank can earn on that at interest rates. You have to get the cost of that entire underwriting process down significantly. So we are an infrastructure company from 2009 building a platform for banks. From the beginning, I've always had a very different approach of who is our end customer, what is the product we're selling, how do we approach the market. You sell banks by deliberately taking steps to build up credibility so that a bank would feel comfortable outsourcing some of its most important capabilities to you. Utilize existing pieces of bank infrastructure. We map to that bank infrastructure so that we can give features and functionality to the bank that they couldn't do on their own. So conceptually, the bank could do what we did if they had plenty of time and research and development and software development capability. In theory, they could take some of their core existing systems and replicate elements of what we bring to the table. But banks don't want to do that, and the more realistic issues are that some of the core banking platforms, for example, or loan management systems used by the banks would just be too much to try to train them or break them to do what we do. So the model that we do is not so much replacing existing bank infrastructure as it is providing a means by which banks can utilize existing infrastructure, but to achieve a much better result using our platform wrapped around their infrastructure. Well, you have to remember that AMP was built with the very notion of servicing banks as a platform basis. The founders and management come from the payment processing business, where the whole idea is to build a core processing unit that banks could outsource to, so that the banks could get the benefit of economies of scale, where all the core infrastructure and work is built by us and then shared with each individual bank. So there's an element of standardization of what a bank can get, but we also recognize that banks will want the ability to customize to their own requirements. Built into the kernel of this, of course, is a recognition that banks will be in different countries, for example. So the platform anticipates different currencies, different file formats, different core banking systems for the integrations that we would do into those systems. And it certainly anticipates that different countries will have different regulations with respect to small business lending. And those regulations in and of themselves cause variations in the way the product will manifest itself to the small business customer. So from there, you could build on multiple ways that a bank can customize a product offering, whether by the type of interest rate, the methodology of amortization, the truth in lending procedures that need to be done to issue a loan in accordance with the applicable legislation. It could be the length of tenor, it could be the drawdown. There are any number of permutations by which our core technology, remember that the product is AMP Credit Technologies, so the core element is to be able to create an ability to assess and issue credit in a manner that the bank wants. Now, the manifestation of that credit can be a term loan, it could be a line of credit. There are a number of different product iterations. And that's what's designed, is to enable the bank to cherry pick what it wants to do within, of course, the limits of the core infrastructure. Well, 2016, in my opinion, is a watershed moment in the evolution of this model of lending. You know, what I am firmly convinced is that many banks will be adopting these technologies and offering loans directly to their small business customers from the bank's balance sheet with the bank's brand, which gives the customer the benefit of lowest pricing available in the markets, because banks have the lowest cost of capital and reputation to protect. It has the best data protection, privacy. All of the regulations that banks have to comply with are, looked at it from the consumer standpoint, protective of the small business customer, whereas alternative lenders don't have to comply with any of that. So we believe, in terms of client acquisition, that banks offering this capability will be the best use for the customer.